You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIW Tweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host John McEwen. In this week's episode, we'll be discussing Coca-Cola HBC, InterContinental Hotels Group, Hargreaves Lansdown, Prudential and M&G, Just Eat Takeaway, and Disney. So, John, should I start us off with Coca-Cola HBC?
Yeah. What were the results this time, Sam?
So, Coca-Cola HBC, for anyone who's not familiar with it, it's Coca-Cola Hellenic Bottling Company. So it's basically the Greek Coca-Cola, but it's listed on the FTSE. And they have the license for the Coca-Cola brand in 27 countries. And those countries are basically Central and Eastern Europe, and Nigeria as well. So it's basically Coca-Cola, but it's Coca-Cola in emerging markets is probably a good way to think about it. So they have come out with their half-year results, and they've included in the highlights that ongoing recovery and effective execution drove additional momentum and share gains in Q2, with half one FX neutral growth of 23.1% like-for-like and reported revenue growth of 14.7%. FX neutral net sales revenue closed 4% above 2019 levels like-for-like. Volume growth was 15.9% like-for-like. They've announced improvements in FX neutral revenue per case, which benefited from pricing taken in over 90% of their markets and positive category package and channel mix. They've said sparkling volume is up 16.2%, with adult sparkling up 37% and low and no sugar up 40.3%. Energy volumes up 66.1%, and that was driven by the performance of Monster, Burn and Predator. The Costa Coffee rollout continues to progress well. The coffee strategy is strengthened with the premium Italian brand Caffè Vergnano, which starts distribution in 2022. They said operating leverage and cost savings resulted in comparable EBIT margins up 340 basis points to 10.8%, and 120 million euros of COVID-related savings were achieved in 2020, and they expect to retain 20 million euros of this in 2021. So they're therefore expecting 100 million euros of costs to return in the second half. So they split their countries into three segments, which is established, developing and emerging. In the established segment, FX neutral revenue was up by 17.1%. In developing, it was up by 17.6%. And emerging, it was up 30.3%. And they highlighted the continued strong performance from Russia and Nigeria. So a couple of other points. The net sales revenue per unit case was up 0.9%. Net profit was up 88% to 233.1 million. And free cash flow has gone from a 38.5 million loss to a 277.5 million gain. There's an interesting point in the slides. So they're actually expanding into Egypt. So they're buying the Coca-Cola producer that's currently operating in Egypt. And they've said with that, they'll operate in Africa's two largest markets by volume. And Nigeria, which they already operate in, and Egypt combined make up approximately 25% of the population of the whole of Africa, which I didn't realize. And they've highlighted the growth potential as they're currently a strong number two in the market with 42% value share, which gives room for further share expansion, as well as the opportunity to increase the per capita consumption. And they're expecting to close this deal in late Q4 of 2021. In terms of the valuation, once you factor in these half-year results, it puts it at a PE of about 21.4. You'd possibly want to caveat that with the fact that the costs are going to be going up in the next half, and they've already said that. So maybe that PE, it's actually a little bit higher if you factor that in. But I think at a PE of 21.4 with those results, and given it's a very good play and probably a very safe play on the emerging markets because you've still got the relative safety of the Coca-Cola brand, I like it.
In comparison with the historical valuation, how does that compare out of interest?
Yes, I mean, in terms of the share price, it's basically back at pre-pandemic levels now.
Yeah.
It's been a little bit higher. It's probably been close to £30 a share. It's currently about 26. It was as low as about 11 or 12 pounds a share in 2014, but since about 2016, it's not really moved that much.
Okay. No, I mean, I do like it. And I think I suppose it's quite exciting that it is an emerging markets play with that safety of Coca-Cola, like you said. I think that would be the draw for me. And perhaps, obviously we would both accept, I think, that Coca-Cola is an incredibly strong brand, maybe even the strongest brand you could imagine, or that is available to buy, but it's not growing massively. So I suppose this is both of those things combined. So now I like it, and it's listed on FTSE 100. So
it is. It used to be listed in Greece. It was the largest stock on the Athens Stock Exchange, but I think they knew they'd get more liquidity and stuff by moving to the FTSE, so they came over a few years ago. Yeah,
no, I like it. And does it pay a dividend?
It does. So the historic yield is 2.15%. Pretty decent.
Not too bad. Yeah, and room to grow.
I think the Egypt deal makes a lot of sense.
Yeah, no, I like it as a company, and it's one, like you said. I think the last time we covered it, we'd said neither of us had really looked at it very much. It's sort of very much been overlooked, but probably prefer it certainly to AG Bar.
Yes, I don't know about Britvic.
I wonder. I'd probably go for Coca-Cola, actually. HBC.
I mean, they are very different in that Britvic is UK.
Absolutely.
So possibly a bit unfair on Britvic. But yeah, it's definitely better than AG Bar.
Yeah, no, fair enough.
Should we move on to InterContinental Hotels Group then?
Yes, so InterContinental Hotels Group are a hotel franchise largely, with 6,000 hotels worldwide, or franchisees. They had the first half results out, with first revenue for the first half down 5.5% to $1.2 billion. But they had improving performances in the US and China. And sadly, they were dragged down by slowdowns in Europe, Middle East, and Africa with ongoing COVID restrictions. Underlying operating profit more than tripled to $188 million, with the increase in demand, albeit from a low base. Average revenue per room, which is one of the key metrics that InterContinental and some hotel groups use. So average revenue per available room was 57% of 2019 levels in the first half and 64% in the second quarter. So it's going in the right direction. The global estate is 88,484 rooms, down from 886,036 in 2020. If we break the results down a little bit more, in the Americas division, revenue was up 31% to $296 million, with a significant demand from March onwards. Average revenue per available room in this division was 66.4% of 2019 levels, and operating profits came in at $220 million from just $5 million in 2020. Revenue in Europe, the Middle East, and Africa was down 37.3% to $84 million, with strict COVID restrictions still in place. There were some positive signs in the second quarter, however. The operating loss came in at $27 million, which compares favorably with an operating loss of $115 million in 2020. Greater China saw revenue more than triple to $59 million. And average revenue per available room there was 84.1% of 2019 levels in the second quarter. Underlying operating profits were $31 million, compared with a $12 million loss in 2020. For the company, the underlying free cash flow came in at $147 million, compared with $66 million outflow in 2020. And net debt fell by $71 million to $2.5 billion. In terms of valuation, InterContinental have a market cap of $8.5 billion, obviously FTSE 100 listed, with a price to earnings currently of 34. So, I mean, it seems as though it's going in the right direction with InterContinental and these results. And you might have argued earlier last year that things were overdone. Well, probably were overdone, but it did change things drastically when you had that sort of paradigm shift with the COVID vaccines. And you can still see in Europe, the Middle East, and Africa, particularly, that those COVID restrictions are really still impacting on the revenues. It's probably not a company that I would buy. I'd be a bit reluctant to buy anything in the airlines, hospitality, and them being, I guess, particularly cyclical. But it does look like the company's turning things around, and fortune in terms of the way COVID is going is on their side. So what do you think of these results?
I mean, the results themselves are a bit of a mixed bag because, like you say, in the countries that don't have the vaccines, you can see that it's really still impacting them. I just thought that the average revenue per available room at 57% of 2019 levels, that's still some way off where you'd want it to be. And I know it rose to 64% in the second quarter, but again, it's still got some way to go. But then when you look at the price, it's priced as if it's already fully recovered. And I don't really get why, because, well, I just don't really understand why it's still so expensive.
Yeah, relative. Yeah, I hear where you're coming from, because I suppose it's like some of those companies that we talked about, Greg's, for example, it fell massively when COVID hit, and understandably so, but now it has managed to return the revenues to, I think, was it above, when we covered it last, above 2020 revenues, whereas this company, InterContinental, hasn't, but it is valued as though it has.
I mean, that's not to say it won't get back to 2019 levels. It's just that you'd expect that risk to be priced in a bit more to reward the shareholders that think it can. And it just doesn't seem like that's the case. I mean, what I would say in its favor is I do like the business model, like the vast majority of the hotels are franchised. So it means they don't have that. It's not as bad for them as it would be if they were running the hotels.
Yeah.
But yeah, I think it's the price that's the main issue for me. Yeah. I'd possibly look at it in more detail if it wasn't at the current levels, because the business model itself, I do quite like.
Because I think the statistic is it's franchised and they have over 6,000 hotels of their brands, but they only own, I think it's under 100.
It's something ridiculously low. It makes you wonder what the point is.
Well, they've got earnings, and that albeit lower than they had been pre-pandemic, but they do make a lot of money from it.
Yeah. What's it called? Terry Smith had that in his fund for a good few years. I don't know if he's still got it now, but when I read the book, he mentioned that quite a few times. Did he say what did he say why he liked it? I think it probably is that business model.
Okay.
Yeah. And also it'll be, because it's a franchise, it'll have a high return on capital, which again is something he's very keen on.
Fine. Okay. Interesting. Okay. One for you, do you think? Or not the current prices?
Not at the minute, but I wouldn't rule it out completely in the future.
Yeah. Yeah. Okay. So we've got one of your favorite companies, Hargreaves Lansdown.
Oh, yes. So I should start by saying I am a shareholder of Hargreaves Lansdown, so I am a little bit biased, and proudly. So they have come out with their full year results for the year ended 30 June 2021. And the highlights include 1,645,000 active clients, which was an increase of 233,000 in the year. Net new business inflows was up 13% to 8.7 billion. Total assets under administration was up 30% to 135.5 billion. Revenue was up 15% to 631 million. Profit before tax was down 3% to 366 million. Diluted earnings per share was down 5% to 62.5p a share. And the dividend was up 3% to 38.5p a share. So, he's obviously done a fairly lengthy statement, but some of the highlights from CEO Chris Hill's statement include: the pandemic has accelerated two trends that were already evident to us: a permanent shift to digital and a change in the demographic mix. Demand for our digital services has soared, with 393 million digital visits and 98% of trades being done online. In full year 21, 83% of our new clients were under 55, as we saw younger clients showing an interest in investing and saving, prioritizing financial resilience as they benefit from the transition of wealth from older generations. In full year 21, 83% of our new clients were under 55. Investor confidence started the year at a low, but swung dramatically on the positive news of COVID vaccines and the political certainty provided by the US election and Brexit. The subsequent upward trend in confidence, alongside a greater interest in markets and trading during lockdown, led to record equity trading volumes, up 54% on the previous year. This was one of the drivers of strong underlying profit before tax growth, up 8%. To put those profits into context, they are now bigger than our net revenues were 5 years ago. While some of this volume of trading has clearly been exceptional and we do not expect it to remain at such high levels, there are two key lessons for us from this year. First, we believe there has been a permanent shift in behaviour, and the key structural drivers for the wealth management industry will continue to underpin our long-term growth. Second, we've been able to capitalise on this extraordinary year and enlarge our client base substantially due to our previous investment decisions and confidence in the opportunity ahead. In the slides, there's an interesting point where they said in 2018, the UK financial wealth market size, they had an addressable market of 2.5 trillion. At that time, Hargreaves Lansdown had 92 billion of it. 2021, it's gone up from 2.5 to 3 trillion, and Hargreaves Lansdown shares gone up from 92 to 135 billion. And they predict that by 2025, it'll be up to 3.7 trillion. They also pointed out that in 2007, the median age of Hargreaves Lansdown clients was 58. In 2014, it was 54. And in 2021, it was 46. And the average age of the new clients in the 2021 year was 37. Oh, it's worth mentioning as well that client number of 1.645 million, that's double what it was 5 years ago. But the share price is about the same.
What do you think is holding it back?
I think it's possibly a case of growing into its valuation. I mean, it's now trading at a PE of 24 with a dividend yield of 2.56, which seems very reasonable to me. There's possibly concern about pressure from like free trade and trading 212 and Robinhood. I mean, I've not seen that come through in the results. I just think, well, yeah, a PE of 24 and the fact that it's got so much going for it in terms of tailwinds for the industry and as a market leader, I think a PE of 24 is very reasonable. What about you?
Yeah, I mean, I guess one of if I were to play devil's advocate with it, do you think it's just that this has been such a bumper year for them? Are they going to be able to continue that? And are there going to be more pressures? Because at the moment, their fees, because I've looked at them sort of personally, from sort of a consumer perspective, they're relatively high. You know, they're definitely not the lowest cost operator. And then there are the sort of, you know, you're trading 212s, free trades, even AJ Bell's coming in and putting a bit of pressure. Along with, you've got the Vanguard platform over in the UK, and I appreciate you can only buy index funds rather than individual stocks on that. But do you not think that those things, while there are a lot of tailwinds for the industry, could put pressure on, well, first of all, growth in the market share for Hargreaves and then their margins as well?
I mean, I'd start by saying if you look at the numbers of the business over the last 5 years, that hasn't happened so far. I think in terms of the free trades, you know, whilst the transaction fee is zero, you pay for it in the spread. So it's not, it's more of a hidden fee rather than it's actually, they're not doing it out of the good of their heart. They are monetizing you in some way. And I think as well, the sort of person that's attracted to Hargreaves Lansdown, maybe it's not the 20-year-old that wants to spend his student loan going all in on Tesla, which is probably what the free trade is more likely to be. It's possibly more a professional with a decent amount of money that's later on in life and just wants an easy to use platform and doesn't mind paying a £10 trading fee. I think realistically, like, I don't know, say you're 40 years old and working as a solicitor and you've got a bit of cash saved up. Are you going to be on the free trade app where it's trying to hit you with the dopamine with the push notifications every 5 minutes, or are you just going to pay the £10 a trade for Hargreaves Lansdown because that's what everyone else in your firm uses? I think you're going to go with Hargreaves Lansdown. So what you're going to see is, I think Hargreaves Lansdown will have a much higher portfolio value per client than your free trade would. And I think that would continue. I think there's an element of sort of brand strength there as well, just because the people with the higher portfolio values, I think they will continue to go to Hargreaves Lansdown, and I can't see them going to Robinhood to save 5 or 10 quid.
Okay, no, fair enough. Do you think it'll put pressure on the margins though? Even if
I think over time, I think that could happen. The view I take with it is, as long as assets under administration continues to go up, I appreciate it'll go down in a bear market, but as long as it continues to trend in the right direction, I think there's always going to be a way to monetize it. There's always going to be something they can do, and when it's at 135 billion, there's going to be a way to make money off of that, and that's going to continue, I think.
And I suppose, like you say, it's not an outrageous valuation at all. So
if it's P of 50, it's a different conversation, I think.
Yeah.
But at 24.
And what's it historically traded at? Is this about in line with it?
I mean, the share price hasn't moved for about 5 years, and the earnings have gone up. So it must. I'll just get the financials up. So yeah, the share price. I mean, it's been a bit bumpier, but over 5 years, it's basically flat. Earnings per share is up about 50% in that 5-year period.
Yeah.
But revenue's up more. Revenue's probably more like 60-70% up. So I think it's just a case of growing into its valuation.
And out of interest, and this isn't obviously an in-depth comparison, but valuation-wise, how does it compare with AJ Bell, and size as well? What's the market cap of both of these players together?
AJ Bell, I'll just get it up. AJ Bell's more expensive in terms of PE. Yeah, so AJ Bell's at a PE of 45 compared to 24 for Hargreaves. Market cap 1.77 billion, and that compares to 7.16 billion for Hargreaves. I think Hargreaves I can't remember AJ Bell's client numbers off the top of my head. I want to say it's around 250,000 or something like that, maybe 300,000 now. And this is off the top of my head, whereas Hargreaves Lansdown 1.4 million. Was it 1.4? I know 1.6 million. It dwarfs it.
Yeah.
And the Hargreaves Lansdown, it's no sluggard. I think it's very impressive numbers.
Yeah.
I'd definitely be picking Hargreaves Lansdown over AJ Bell. And I have.
Okay, fine. Okay.
All right, shall we move on to double whammy of Prudential and M&G?
Yeah, okay. So the double whammy is the UK listed insurer Prudential, which you might have your pension with, or you probably heard of. They've had their half-year results out, and they reported a loss of $4.6 billion. And that's largely attributed to a $7.5 billion write-down in the value of Jackson, which is the US life insurance business. And that's ahead of the planned demerger, which is due for completion by the end of next month. If we exclude Jackson, the group reported a profit after tax of $1.1 billion, which is up 64% year on year. Life insurance new business sales in Asia and Africa were up 17% at constant exchange rate to $2.1 billion. That was reflecting impressive growth, particularly in mainland China, but also Malaysia and Singapore. And that was coming through both agency and bank channels, and Prudential's new direct consumer Pulse app, which accumulated or accounted for 10% of sales in the markets where it's now available. However, in Hong Kong, as might be expected, sales are down 35%. In the asset management part of the business, which is called eSpring, funds under management were up 16% to $254 billion. That was underpinned by funds from the group's insurance products and market movements, obviously being in a bit more of a bull or recovery market. And this division saw net outflows from external clients of $509 million. But that was a big improvement on the previous year, or the same period in the previous year, of $8.4 billion of outflows. eSpring reported underlying operating profits after tax of $147 million, which is up 17%. Prudential's operating free surplus, a key metric relating to cash generation, was up 9% to $965 million. And the group's GWS capital position is strong, with a $10 billion or $10.1 billion surplus and 383% coverage ratio. That was up from 9.4 billion surplus with 370% coverage at the start of the year. In terms of valuation of Prudential, it currently has a market cap of $39 billion and a price to book of 2.82. 10-year average has been 2.69. It's currently got a dividend yield of 0.9%, but we'd expect that to come back a bit more as dividends begin to be reinstated and it returns to profit. In terms of M&G, I mean, the reason for mentioning M&G is because similarly to the Jackson division, that was, well, not quite the Jackson division of the UK, but it was an asset manager or the asset management division of Prudential in the UK, and it also had its own annuities business. In terms of M&G, they're also, after demerging, they're also listed on the FTSE 100, and they currently have £370 billion worth of assets under management. They were spun out in 2019. They had the half-year results out and reported an operating income of £917 million in the first half, which was up 7.5%, with growth across the business. Operating profits were up 5.8% to £327 million. And the board also announced an interim dividend of 6.1p a share, which is up 1.7% of last year. And it was of note last year that they didn't actually cut the dividend, so it's now over 8%. If we break those results down a little further, in the savings and asset management business, the fee income in the first half came in at £606 million, up 4.5%. And that was largely underpinned by the positive market movements offsetting £2 billion worth of client withdrawals. So assets under management actually rose 2.5% to 238 billion. Within the same division, the institutional asset management business saw an impressive inflow of £2.2 billion. However, the retail savings and retail asset management both had outflows. And furthermore, the average asset management fee margin fell from 0.36% to 0.33 percentage points, with increased pricing pressure in the retail asset management business. In the Heritage, which is the annuities division, that reported £157 million of income from annuities, up 12.9%, with profits flat at £108 million. The improvement in the annuities is as a result of various releases relating to pending sales of the annuity book to Rothsay Life and the release of provisions for possible mis-selling. There were no changes to the longevity assumptions based on COVID-19. M&G generated £869 million of capital in the first half, up from £202 million of outflows a year earlier. Operating capital generation was £309 million, down from £539 million. Operating and overall capital generation more than offset the generous dividends paid in the first half, with a Solvency II ratio coming in at 198% from 182% at the start of the year. In terms of valuation, M&G has a market cap of £5.3 billion with a price to earnings ratio of 10.3. And that's, since listing 2 years ago, it's averaged 8.1, but we have had the pandemic in the middle. It's currently got a dividend yielding 8.8%. And to elaborate a little bit more, the sale of the legacy annuities business of Rothsay Life, that really hopes to make the group much more capital light and avoid the risks that a company would typically take on with life insurance. So it's the client rather than the asset management that going forward will be taking the risk on at M&G. But these two companies, obviously, until a couple of years ago, they were both part of Prudential. How do you see Prudential going, Sam? And I appreciate insurance is not something that you generally like to look at, but it is with the FTSE 100. These are sort of, I guess, stalwarts of the FTSE 100.
Cornered me now. I can't just put it in the too hard pile. Yeah, I don't know. I mean, Prudential's results looked quite positive overall, I'd say. M&G seemed like a bit of a mixed bag. I remember last time we looked at M&G, it seemed like a bit of a mess. I think M&G at a PE of 10 seems quite expensive, considering the dividend's probably going to get cut at some point. And it's a shrinking business, isn't it? I know they've really struggled to stop the outflows. So I'd definitely prefer Prudential to M&G, but yeah, I'm not massively keen on either. I think the Prudential, based on those results, it looks like they've had a decent year. Like I say, I do really struggle with them, and I've not seen anything in them yet that makes me think, oh, well, I should learn how to look at this because this could be quite interesting. I'd probably by default just latch on to the operating free surplus, which is the measure of cash generation, which was up 9%. I guess that's like the closest thing you can get to like operating cash flow, but yeah.
Would you be more attracted to Prudential once they've got rid of the Jackson division, and it's more a pure play on the emerging markets and insurance?
Probably. I mean, if they've had a 7.5 billion write down on it, it doesn't look like the Jackson's division is doing particularly well. So I'd say without that, it's almost certainly going to be more attractive, but I can't see myself ever seriously looking at it. What about you?
I already own it, so yeah, it's not something I chose myself, but it's been in the portfolio for a long time. I'm enjoying taking the dividends, which I think they seem to still be able to cover it at M&G. Obviously, Prudential I think had a much higher yield before that was sold off, and I suppose Prudential, they may have more progressive dividend policy going forward, but it is probably going to be more growth orientated once Jackson is spun off. I suppose the attraction of Prudential is Asia. I mean, I think that's what's probably over the last 5 or 10 years drawn people to invest in Prudential. It was never for the older bits of the business like M&G and like Jackson, but I think they probably will be a more nimble company and have prospects for higher growth going forward. And how exactly it's going to work with Jackson and whether Prudential shareholders are going to end up with Jackson shares, I'm not exactly sure. But I've had it for a number of years, but it probably would have doubled in value since I've had it. So it has grown, but that growth has been from what was going on in China, I suppose. Will I continue to hold it? I don't know long term. I suppose you could say it's sort of served me well, and it definitely has outperformed the FTSE 100. But it wouldn't be probably if I were to pick a stock, and given that I predominantly invest in the index, it wouldn't be one I'd go out and pick today, probably.
I already know for a fact it's not going to be your pick of the week.
Okay. Yeah. There are some more exciting companies coming up that you mentioned already, Sam.
And there's one to come. I think pick of the week, it's almost certainly going to be Disney for you. So I'd say, why don't you just get some more Disney with your Prudential?
It would certainly be a lot more Disney than if I sold my Prudential. And would you sell if you were me, would you sell your M&G shares as well?
I like M&G even less than I like Prudential. I'd sell Jackson's once you've got them as well.
Yeah, it is difficult to value them, though. I think that is that's probably one of the things I've struggled with, particularly with M&G. It's well outside sort of my own expertise. I mean, we were talking sort of off air, a year ago about it, and you're like, I just offload it now, but it has doubled. It has doubled in value since then, and it is very difficult to know what it's worth. And I think unless you do have the expertise in looking at, I suppose, banks, insurers, these companies are very, very challenging.
I just think, like, for me, it would be the opportunity cost. It's like it would literally be a case of, why would you want to hold Prudential when you could own more Disney? I don't want to spoil the Disney results that are coming up, but I just think, for me, it's like, well, I'd want more Disney.
Yeah, and it's fair enough. And I suppose at that point as well, certainly when I did buy the Prudential shares, it was a case of only looking at the FTSE 100 and having that sort of home bias rather than, looking. It was that home bias, just looking at the FTSE 100 and trying to pick things from there. And I guess if you looked at the FTSE 100, 5 or so years ago, which countries would have that sort of emerging markets play? Of course, we didn't have Airtel Africa listed then, Sam.
Well, it's not even FTSE 100, it's only FTSE 250.
Prudential is 100.
I'd count, but Airtel Africa's 250.
Oh, sorry. Okay, fair point.
I'd counter and say if you wanted a FTSE 100 emerging markets play, Prudential's not even the best one we've done this episode.
Yeah, well, there is Coca-Cola. That's right. I suppose you might say with Coca-Cola, it wasn't so much the sort of emerging markets in the sort of Asian sense. They're more.
No, it's not Asia.
You're
Eastern Europe and a little bit of Africa.
Yeah. But that was always something that would be argued with a company like Unilever as well, that most of their growth is coming from emerging markets rather than in where they essentially reach saturation point in the developed world.
Right, shall we move on to Just Eat Takeaway then?
Yes, Sam. So Just Eat
Takeaway have come out with their half-year results. I'm assuming everyone knows Just Eat.
Well, after all the money they've spent on advertising, you should hope so.
If you've watched the Euros, you must know who Just Eat are. Yeah, so they've come out with their half-year results, and they've announced revenue up 52%, and that's 63% if you exclude Grubhub, to 2.6 billion euros. Said adjusted EBITDA on a combined basis for Just Eat Takeaway.com was negative 190 million euros in the first 6 months of 2021, representing an adjusted EBITDA margin of minus 1.3% of gross transaction volume, reflecting the significant investment efforts of the company. It's interesting that they've highlighted it as minus 1.3% of gross transaction volume. I've just picked up on this now, but obviously that's not revenue. So obviously the real margin would be a lot worse. But anyway, they've said, given the widening of the price gap in consumer delivery fees versus its competitors, the company has more flexibility to improve its adjusted EBITDA going forward. While the benefits from this development will already be visible in the second half of the year, Just Eat Takeaway.com will continue to invest significant amounts in providing the best and most affordable service to the consumers across the world. So I interpret that as basically saying that because they're the cheapest by some margin, it's good for margins because they can increase prices in the future. As if, I don't know, it's as if someone else wouldn't come and try and undercut them if they did that. So I think that's maybe wishful thinking. Yeah. They said Just Eat Takeaway.com has reached the peak of its absolute losses in the first half of 2021. Improved profitability will be driven by growth and increased scale of the business, flexibility from the widening price gap, product and technology improvements, operational efficiencies, as well as fee caps, which are expected to partly fall away going forward. In the first 6 months of 2021, Just Eat in the UK added a record number of 58 million orders to 135 million orders, representing the highest absolute order growth in the sector, about double the absolute growth pace of its competitors. The average monthly order frequency in the UK reached 3.2 times, up from 2.5 times a year ago. In London, Just Eat gained approximately 10 absolute percentage points online share since the beginning of the investment programme in the third quarter of 2020. In the first 6 months of 2021, further investments were made into the rollout of delivery in Germany while improving operational leverage. The German business generated 94 million euros of adjusted EBITDA, up 63% from 58 million in the same period of 2020, while overall orders were growing by 62%. Delivery orders in Germany grew 110%. Canada, including fee caps and restaurant support initiatives of 32 million, generated 4 million of adjusted EBITDA in the first 6 months of 2021. Skip the Dishes opened the first Skip Express lane, which makes it the first large player in Canada with a convenience delivery hub. The company believes it can run Express Lane profitably at scale because of the underlying profitability of the whole Canadian business, which is almost fully a delivery business. In the United States, Grubhub processed 134 million orders in the first 6 months of 2021, representing a growth rate of 27% compared with the same period in 2020. Management reiterated its guidance for the full year 2021, which was order growth above 45% year on year, excluding Grubhub. Gross transaction volume, including Grubhub, expected to be in the range of 28 to 30 billion euros. Adjusted EBITDA margin in the range of -1 and -1.5% of gross transaction volume. The company's cash position amounted to 1.519 billion at 30 June 2021, and management reiterated its intention to monetize its 33% stake in iFood, which is the Brazilian version of Just Eat, if an appropriate offer is made that reflects the size and superior growth of this asset. The highest bid to date amounted to 2.3 billion euros and fell short of management's expectations. And there's an interesting point in the slides. So they commented in their what makes them a major player. They've said, we only invest in markets that are or will grow into profitable market leadership positions. And then they've said, only market leading positions will return a profit. Now, I read that and my first thought was, why did you buy Grubhub then? Because it's the third biggest player and it's the third biggest by some way. And the growth is behind the top two, I think. I don't
and
think
the top two being Uber Eats and Deliveroo, or
no, it's not Deliveroo, and they've got one called my mind's gone blank. It's DoorDash, I think. I think that's what it's called. DoorDash. DoorDash is the biggest. I don't know what number two is off the top of my head. I would guess it's Uber Eats. I think Deliveroo's only UK.
Yeah, no, you're right. It is.
Yeah, but yeah, so they're number three. They used to be number one, and they just didn't execute very well, so they just got overtaken by DoorDash. Anyway, we won't go into that. We've criticised that acquisition enough in the past. In terms of the market cap is £13.82 billion. It doesn't have a PE because it's loss-making. What we'd normally try and do with the American companies is we'd use a price to sales. However, that generally only works for high gross margin businesses. In theory, Just Eat would be a high gross margin business if it weren't for the delivery side. They actually, interestingly, so if you go into the accounts, for a business like Rightmove, for example, in the accounts, they won't give you a gross profit because it's basically, it just flows, it's basically all gross profit. So there's no point actually giving it. Just Eat have tried to do the same thing when you look at their figures, but I would actually say the courier costs are a cost of sales. And I think Just Eat could give you a gross profit figure. I understand why they wouldn't want to, but I think they could. But the courier costs make up 58% of the revenue. So that would give them a gross profit margin of 42% if you said that was the cost of sales. I think it's likely that that gross margin would actually come down as they increase delivery more and more. So because of that, price to sales doesn't really work, I think. I struggle to value it because of that, and I don't see the business model working. I think for me, it goes in the same pile as Uber and Deliveroo, where it's a really good business for the customer, but I don't see it being as good for the shareholder. What about you?
It's with the risk of being boring, I'd say exactly the same. I just wouldn't even look at it. I did quite like Just Eat a few years ago before the merger. Was it a takeover, a merger?
It was a merger, I think.
Technically,
it was a merger.
Prior to the merger, I think it was a much more attractive business, and I probably would have looked at it. Well, in fact, we did look. I think we did look at it.
I owned it for a week.
Yeah, was that before the merger?
It was the week before the merger. It's complete luck. But I made like 30% in a week.
So you did, yeah. Which is, it is a different business to what it was. It's I mean, it's bigger, but it's not more attractive, and the margins and things. Yeah.
If it was Just Eat, or even Just Eat takeaway without the delivery, and without Grubhub, it's the sort of business I'd really look at. The only caveat I would say is that if it didn't have the delivery, someone else would come and do it, and then the restaurants might just move. So I sort of understand why they feel like they have to do the delivery, but I don't think it puts them in a good position.
So they sort of, it was necessitated, really.
I think so, yeah. So should we move on to our American company then?
Yes. So a company that you've mentioned before, and that probably doesn't need very much introduction, is Disney. Had their third quarter results out, and they reported that revenues in third quarter were 17 billion, which was up 45% and ahead of analysts' forecasts. The strong recovery was largely underpinned by the recovery in the parks business. Meanwhile, operating profit more than doubled to $2.4 billion. If we break the results down a little bit more, in the media and entertainment distribution business, revenues were up 18% to $12.7 billion, with a 57% rise in sales in the direct consumer business, notably Disney Plus, where subscribers more than doubled to 116 million. However, with higher programming costs in this division, it meant that operating profits actually fell 32% to $2 billion. In the Parks, Experiences and Products division, revenues rose from $1.1 billion to $4.3 billion, with domestic park revenues up from $213 million a year ago to $2.7 billion in the final quarter, in the third quarter. And international parks were up from $116 million to $526 million, and consumer products up from $736 million to $1.2 billion. Domestic parks broke even this quarter compared with a $1.6 million loss in the same quarter last year. The division overall reported an operating profit of $356 million from a $1.9 billion loss. Free cash flow for the first 9 months of the year was $466 million, down from $2.7 billion last year. That's largely reflective of the increase in content and cost production, with studios being reopened. Net debt stands at $39.8 billion, slightly down from the $40.7 billion reported at the end of the last financial year. And that's really a hangover from the acquisition of 21st Century Fox, which was, I think, over $70 billion. In terms of valuation, the market cap of Disney is ginormous. It's $327 billion, with a price to earnings ratio of 39. And that compares with a historical 10-year average of 25.9. And it's yielding just under 1%. Sam, thoughts on these results?
Well, they're obviously fantastic results. I think every single number moved in the right direction. I mean, you could maybe point out that the operating profits fell in the media division, but, well, it's because they're increasing the content spend, which I have no issue with. I think a PE of 39 is pretty reasonable, considering it's still not at 2019 levels. And I think, obviously, that 10-year average of 25.9 does not include Disney Plus. And I think that in a few years' time could be seriously contributing to the profit levels.
Yeah,
I am biased, actually. I think it's, for me, it might be the best business in the world. What about you?
Yeah, I mean, I really like it. I own it. Things are going in the right direction with the reopening of the parks. And I guess most of that revenue does come from the US parks, so the domestic parks. And as we saw with InterContinental, the Americans seem to be going back to these things more quickly than perhaps they are in Europe and in the rest of the world. So that's reassuring, especially considering the most of the parks revenues does come from the US. And then, yeah, it's super exciting with Disney Plus and what they're going to be able to do to that. And I saw the statistic that they have now, I think it's over 80% of the subscribers of Netflix in their direct consumer division now.
So that's when you add Disney Plus, ESPN Plus, and Hulu
exactly
together.
But that stat alone, when you consider the size of Netflix and its market cap, is pretty impressive.
Well, they've set a target for Disney Plus of over 200 million subscribers. I think it's by 2024. I think they'll hit it.
Yeah, no, I think
200 million subscribers, and as well, there's no way the price is staying at current levels because it is too cheap.
It is, yeah.
It's one of the few subscriptions I've got where they could double it and I'd carry on paying.
Yeah, no, I agree. And the content on it is fantastic, and all of that intellectual property that Disney own, it's what a company.
Yeah. So, of the 7 companies we've talked about this week, Coca-Cola HBC, InterContinental Hotels Group, Hargreaves Lansdown, Prudential, M&G, Just Eat Takeaway, and Disney. If you had to buy one, which one would it be and why? And which one would it be also if you weren't allowed to buy Disney?
Okay, so, well, I'm very predictable, but it would be Disney. And I think it's the quality and the value that's in all of that IP. And then the fact that they're able to deliver it through that sort of direct consumer. I mean, that is fantastic. And it's also, I mean, the parks business alone is, good, but the rest that comes with it is just fantastic. In terms of from the others, I find that a little bit more tricky. I'd probably go for Coca-Cola HBC, I think, partly because it's got that quality brand behind it of Coca-Cola. I think Coca-Cola actually own a 10% stake or something in the business anyway. And it's got that emerging markets play, which you might get a bit more excitement, a bit more growth from it than you would from just owning pure Coca-Cola. So that they'd probably be my choices for this week.
I would also go with Disney for the exact same reasons you've said. I honestly do think it's the best business in the world. Without Disney, for me, Hargreaves Lansdown would pick Coca-Cola HBC, but it's close, and I do like Coca-Cola HBC. And I could see myself opening a position in it at some point, although it won't be in the near future. So I think that's everything then.
Thank you again for listening. We'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.